Hi everyone, welcome again to another financial analysis video. Myself, Moeed Amin, and my colleague Ted Wayman. Today we're going to be looking at Avalara. So this is a SaaS company, one of quite a few that I would like to look at in this industry. I'm quite familiar with the industry. I'm involved with the industry from a sales perspective, so it'd be very interesting to look at businesses like this. Now, Avalara, essentially what they do is they help companies achieve compliance with their transactional taxes. So it's especially valuable for e-commerce companies if you're selling into multiple jurisdictions, right? So whether it's across states in the US or even internationally, it can get very complex to stay ahead of all the tax calculations and liabilities and staying within the regulation and the law. So they have software that helps you kind of automate that to make sure that you're a bit more accurate. So we'll go into the finances for that business shortly. But before we do so, don't forget to like, share, subscribe, especially if you've requested this video. Subscribing to our channel, you will get automatic notification of when your interested company comes out. So this particular one, before we go into the finances, it's worth noting about the stock movement. So they floated in June of 2019 at a low cost of around 44, not low, but at a price of $44. And if you held on to those shares, you'll be sitting on $175 right now. So it's definitely grown. And we'll look at what the finance is, if they can share and kind of give us any insight around that. Also worth noting, 2 weeks ago, this company announced that they're offering $850 million of convertible senior notes that are due in 2026. Now, we've talked about convertible notes in quite a few of our companies in the past, companies like Deliveroo, etc. It won't show up in their finances that we're looking at right now, but it is worth noting that for any future financial statements that you'll be looking at. So Ted, let's take it away and share with our viewers what we found.
Yeah, good to see you, Moeed. I thought actually before we look at the finances, I just give you a little quote. This is from a chap called Donald Rumsfeld. You remember, you may have heard of him. It talks about the great and the known unknowns and the unknown unknowns. And he made a quote. He said, the tax code is so complex and the forms are so complicated that I know I cannot have any confidence that I know what is being requested. And therefore I cannot and do not know. And I suspect a great many Americans cannot know whether or not their tax returns are accurate. So, these guys, they provide a valuable service, and that's just the US. So you're absolutely right. If you're trading in multiple jurisdictions, then you've got a big challenge on your hand in getting the tax right. And if these guys can solve that, then it's a big plus. So let's go and have a look at their accounts. They're a US company, so we're looking at the Form 10K. Here it is, and we need to scroll down to page 65 to find their accounts, and here they are. So we are going to start with the income statement. Here it is, and you'll notice that they provide two services. They have the kind of subscription and returns, and then professional services. So the subscription will be kind of standardized. It's kind of, that they'll plug their software into your software and do all the tax calculations and file the relevant stuff, automatically. But then they're providing additional consultancy on top of that. And what they've done with the revenue, let's just clear those two. They've actually taken the subscription and then they've identified the cost of providing that subscription service, and we'll just do this in a different color. They've also identified how much money they make in providing professional services and the cost of providing those professional services, which will basically be their consultants. You'll notice we're dealing in dollars and we are dealing in thousands of dollars. So basically their turnover is 500,000, which is $500 million. So $500 million is their turnover, significantly up for 2019. Look at that increase. That's a massive 31% growth. And very, very nice, big, fat operating profit. This is a 70% margin. This is basically saying for every dollar they generate in revenue, it's only costing them 30 cents to generate that revenue. Okay, so that's a really nice, big, fat, juicy margin. This is looking pretty good so far. However, when we look at the operating costs down here, the costs of running the business are very large. Now, the admin, the SG, well, the sort of the general and administrative, that's the kind of just the back end, just keeping everything ticking along, only 95 million. But look at this, sales and marketing, they're growing. There's a lot of money being spent in kind of capturing market share, convincing companies to come on board, and a lot of money being spent in R&D. Now, I don't know what that R&D is, whether it's software R&D or whether they're just researching latest versions of tax codes, because they're going to have their tax accountants all over this. It's got to work because, of course, if you've got, literally thousands of companies plugged into this software, one little error and it's going to cause them a massive, massive headache. Sum total here is they are trading at a profit and they are operating at a loss. And they've been operating at a loss. They were operating at a similar loss in the previous year and in 2018. So this company has a history of making losses. Now, it's a rapidly growing company. It's I don't know how new it is, but often you'll see companies, they'll operate at a loss to begin with, to get that kind of traction, and then they will return to profitability. But at the moment, these guys are operating at a loss. And just one last thing, just reflecting what you mentioned earlier about the convertible debt, you'll notice there is no interest right now. So there is no debt, or we wouldn't expect to find any debt on the balance sheet. Check when we look. So if they do have convertible debt coming on, and that convertible debt is lower risk, or not lower risk, it's kind of a higher incentivized debt for the debt providers, because it gives them the option, the right to convert that into equity, which means that kind of, if the company goes ballistic and it goes really, really well, they can go into equity and benefit from it. But if it doesn't, and it sort of trundles along and then coughs and splutters, they can stay as debt and try and get some pennies in the pound out. So there is our income statement, and really, a high growth, high margin business, but with high overheads. And that's our takeaway from that. Here's the balance sheet. Whiz onto the balance sheet. So a few things to notice here. First of all, we are looking at they've got the current assets. Let's start with the non-current assets. That's traditionally where we usually look at. So here are the non-current assets in here. You'll notice this is the total assets down here. That's the total assets figure. And the biggest number easily in their non-current assets is this number here, goodwill. Okay, the goodwill has risen significantly since the previous year, and goodwill arises on acquisition. So basically what's happening there is that the company, it's posting very, very high headline growth, but that growth isn't organic. It's coming through acquisition. It's buying companies which are in a similar position to it, and basically sort of bolting them in and using those kind of customer relationships, etc., etc. In spite of the fact that they're spending an absolute ton of money on marketing and sales as well. So that's really kind of the standout from the non-current assets. If we go to the current assets, up at the top, that's these numbers sitting in here, which are totaled $832 million. Easily the biggest number jumps out at us by far and away is the cash. This company has a lot of cash. It had a lot of cash last year. It's got even more cash this year. So got a strong balance sheet. It's got lots and lots of cash sitting in there, and it looks like it's using some of that cash in order to grow the business through acquisition. Let's scroll down to the bottom half of the balance sheet. Look at the liabilities and the equity. Liabilities actually pretty low. So here are the current liabilities, the 378. So 378 compared with 832. Liquidity is not a problem for these guys. These are not about to fall over. They've got tons and tons of cash, almost more cash than they know what to do with it. Very, very strong on the balance sheet. There's no debt sitting there. So the long-term liabilities are relatively low. And again, what also jumps out at us on the current liabilities is this number here. Now, this is a deferred revenue. Is basically revenue you've received but not yet earned. This is a very, very high figure. This is basically customers are paying their subscriptions and they're paying in advance of earning or of receiving the service. So from a cash flow point of view, this is really, really good. They've got lots of cash coming in. Traditionally, companies will sell a service, bill the client, and then collect the money in. These guys, you know, and it's going to be sort of typical for a software as a service that they are saying you need to subscribe, and then we will provide you your service. So very, very strong. We'd expect to see very strong cash flow from this company. However, they are making a loss. They have been making a loss. They're still making a loss. They're sitting on lots of retained losses. So we can see here they have a lot of money that they've raised from the shareholders. It's up from nearly $1 billion at the end of last year to 1.6 billion this year. And they have been making losses of 600 million so far. So, you know, it's a good, strong balance sheet, but you know, at some point we quite want them to actually start making a profit. I'm sure they will do. There's no kind of warning signs that they're gonna wobble and fall over in the meantime, but we would like to see that return, or not return, and actually, you know, putting the profitability on the bottom line. Even Tesla have managed it, so these guys should be able to as well. Nothing really exciting in the movement in shareholders' funds. Really just to say that you know, they're obviously they're not paying out any dividends. So cash flow, here's the cash flow. The cash flow says they're making a loss, which we know about, but they are generating cash. There they go, $42.6 million. As we'd expect, they may be making a loss, but they are very, very cash generative. They weren't in 2018, but they are now. Lots. So the losses, the accounting losses, not too good, but good, strong cash generation. Now, some of that cash generation is coming from stock-based compensation, okay? So they are paying in shares, okay? Now, that's diluting existing shareholders, so that's not so good. However, there's lots of depreciation in there as well, which is a non-cash item, and they've got this deferred revenue coming through. So stock-based compensation, you could start, you know, I guess if you could argue that if you take these numbers out of the cash flow, then you're on negative cash flow. So you can't pay your staff in shares forever. So maybe there's an issue there, but they are generating cash, and that's good at the moment. And if we go a little bit further down, investing activities. So this year, big investment activities, and there you can see there's the purchase of the business acquisition. You remember goodwill increased significantly, and there we see the purchase of this business brought into their fold. So they're buying growth; they're not growing organically. And then also they are financing through the issue of stock. So there's the issue of stock going on. They're compensating in their staff in stock. There is therefore dilution going on unless you're a part of a rights issue, and they're getting some money from exercise of stock options as well. So they are, you know, they're getting money coming in, and the sum total is, if you look at these two numbers down here, you know, they started the year with nearly $500,000. They finished the year with over $760 million, lots and lots of cash. You know, very, very strong balance sheet. So, you know, reasonable cash flow. A little bit nervous about the size of that stock-based compensation. As I said, you know, people have got to eat, so you can't continue to pay them in shares. You've actually got to physically pay them in, you know, in the ready money. So, you know, it's not as great as all that, but they are generating cash. There's, you know, they just need to get that profitability. They need to kind of hammer down those overheads. They need to get, you know, the sales, the marketing costs that R&D is very, very high. You know, either they need to hit critical mass at the top line, which is the sales, and start to show profitability, or they need to start sort of, really sort of hunkering down and showing that profitability. And I think then, it will start to come very, very good indeed. It'd be interesting to know what their plans are with that deferred debt. And if anybody knows the answer to that, then please do leave a comment in the chat. So there we go, Avalara. Let's have a look at the share price. So as you mentioned, Moeed, the share price has risen, not exponentially, but very, very significantly. No P ratio, obviously, because there are no earnings at the moment, so that's an irrelevant measure. So maybe we can think about some of the other measures. These guys, they're valued 30 times sales. Okay, I don't know if that's a kind of industry standard. The net asset value on the balance sheet is about $1 billion, and they're valued at 15 billion. So it's it's almost entirely goodwill. Again, you'd kind of expect that. They're a software. They don't have any assets. They've got a ton of cash, and that's basically it in terms of their assets. It looks to me like if the product does what it says on the tin, then it looks a pretty important service. If you're someone like Amazon and you're located in country A and buying in country B and selling into country C, and you're doing that kind of for multiple different product lines in all different directions, you don't really want to be worrying. You need somebody like this to just go, you deal with it, that you're the expert, you sort my tax returns out and make sure I'm filing. And I mean, I do my own, and quite frankly, they're complicated enough. I failed my tax exams more times than I care to mention, but don't mention that to anyone, Moeed. So there you go. It's an interesting company. I think it's expensive. I think the accounts look reasonable, but pretty strong company. Just need that profitability, and that's kind of the last box to tick. Once you've ticked that, who knows? Maybe the sky's the limit.
Yeah, that was really interesting to read and analyze. And it's worth noting for our viewers and listeners. Look, we are only looking at this from the fundamental financial analysis, right? If you're going to have an investment thesis, and if you're watching this video because you're thinking about investing in a company like Avalara, there's a whole host of other things that you must look at, and we recommend you do so in order to build a strong thesis. Things like, for example, they are also embedded within companies and have integrations with companies like Shopify and Wix, etc. So the more of these smaller kind of mid-size or smaller size e-commerce companies out there that are working with those types of companies and they're plugged in with Avalara, the better for Avalara as well. So there's a lot of information here that you should be looking at. But hopefully this has been an informative video for all of you. And as Ted mentioned, we'd love to hear from anyone that is an expert or very knowledgeable in this industry and knowledgeable of Avalara as well. Leave your notes in the comment section, like, share, subscribe. And if you do want us to analyze a company that you are interested in either doing business with or investing in, or for whatever reason, do leave a note in the comment section. Most of our videos now are actually companies that we're analyzing based upon requests, so your voices will be heard. Until the next video, thank you, everyone. Thank you very much, Ted.
Good to speak to you, Moeed. Catch you later.